Now, Southern California's new winter ABC 7 occupancy. Conflicts of applying pressure for you to apply.
Okay. Becton, you're back?
Yes, good and ready once you're...
Yes. Okay. Okay. We can start. Welcome, everyone. So my name is Mikaeli Jesang, and today Assurance Africa is holding its first ever ESG discussion. So today we'll be looking at a number of topics. So 4 key areas. We'll be looking at sustainability in terms of the definition of sustainability. Then we'll be looking at ESG. What does ESG really entail? And we'll be dissecting the standards in terms of IFRS S1 and S2. And also we'll be looking at assurance. How do we provide assurance around the subject of ESG? So to take us through that, we have Becton Nyakango. Becton Nyakango is an established internal auditor and also a sustainability expert. So he has experience around providing assurance around sustainability and matters ESG. He has a background around auditing and also advisory services. So he has he currently actually works for SCA Lion. He has actually worked for Siva Logistics and also KPMG East Africa. He brings on board experience across 15 countries where he has supported clients around audit and sustainability matters. He is also a certified public accountant and a certified internal auditor. He is also a GRI certified sustainability profession and a certified risk management assurance provider. He is also a member of the IIA Kenya Board Committee and also the FISA UN Board, and he's currently pursuing his certification in fraud examination. Kindly help me welcome Becton. Becton, you could tell us a bit around the difference around ESG and sustainability. What's the difference between the two?
That's a very good question, and I generally like the term sustainability in contrast to ESG. ESG is short for environmental, social governance, which are some of the pillars which underlie what we would term as social progress. The reason why I like sustainability is because it includes the consideration of the economic dimension as well. But maybe just to provide context, because I like history as well, there's a historical background to these terms as well. As early as around 1713, that's when someone first used the word sustainability, a German forest official who was making reference to our depletion of forest reserves, and he suggested that we should only use as much trees as can grow back, and that's what was then termed as sustainability. But as we come out of the World War II in around 1972, I could miss on the dates, there was again concern that the population growth and the post-World War II industrial growth as well would lead to the depletion of resources and environmental degradation as well. And as a result, the term sustainability is used again in that context, referring to the resources that we are using and our preservation of the environment. In, I believe it was in 1987 at the, I'm not sure if I'm pronouncing it correctly, Bratland conference when the UN officially provided the definition of sustainable development, being development in the present that does not take away the ability of the future generations to meet their needs as well. And that has been the underlying definition up to date. And so if you ask me the difference between sustainability and ESG, I would say sustainability is the more broader concept, and ESG is just some of the pillars which drive sustainable development.
Great, Becton. I'll allow you now to go into the detail of what you have in place or in store for us. For the rest of us, we can post in the questions. We'll handle that once Becton is done with the presentation. Take it away, Becton.
Thank you, Michael. I'll just dive in immediately. And so given that backdrop of history that I gave, you will consistently see me use the term sustainability. If you're more comfortable with ESG, you can swap them. It's okay. I'll also spend a significant amount of time giving background and overview to what sustainability really is and the ESG concepts that underlie it. The reason why I'm doing that is because this is the first of several conversations which will be happening. And I generally feel that one of the reasons that we are not making enough progress in these areas is because we've not stepped back to understand the why. And so I would really want us to appreciate that. Jumping in, think about the societal challenges that we currently have, and they would be underpinned by some of the human needs that we have to have good health, to feel respected within this society, fresh air to breathe, water to drink, to be within a livable ecosystem in terms of climate. And some of the challenges that we currently experience or report as global challenges are those that inhibit us from experiencing those needs in a sustainable manner. These conversations have been there for a while. And as I was highlighting the United Nations meeting to consider these challenges, and some of them potentially being existential crises requiring urgent need, there was the definition of Millennium Development Goals and SDGs later on in 2015 and 2016. But there is a very interesting and fascinating concept that I would like to acclimatize us to as well. The Social Progress Index, which is actually linked to the SDGs and basically underlie criteria or dimensions that measure human well-being, opportunities and freedom that they have. And one of the groups has been assessing the progress that we're making towards achievement of SDGs and the Social Progress Index as well. And something fascinating that they noticed is that when they monitor the Social Progress Index against the GDP per capita, there is a realization and recognition that at the initial stages, GDP is driving and accelerating the growth in Social Progress Index. But at some point, it stops accelerating at the same rate at which it was moving in the advent stages. Someone called Michael Green. I was listening to him some time back, 6 years ago. And what he did, he tried back in 2015 to project if the economic growth, or rather the GDP per capita, the average GDP per capita of the world would grow from where it was, $18,000 in 2015 to around $23,000, which is almost double in 2030 what the social progress index would be. And what they realized is that the growth, which would be driven by almost a double growth in GDP, would only be 1.4. So the social progress index would only move from 61 to 62.4, which brought in the realization that for real and sustainable growth within the world that we live in, you need to look at the other dimensions of life that we experience. And these are usually surmised in the SDGs. And when you look a little keenly, when you look a little keenly, all these SDGs can be categorized into the four dimensions that we talked about earlier: environmental, economic, and social progress. But there is also the idea that this progress has to be driven through policy and oversighting bodies, which introduces us to the conversation around governance. This is the latest report by the SDG monitoring body, and across it you can see that if we go on in the traction at which we are moving, we are still going to be experiencing some of these challenges that have been identified before. Important to note is that by 2030, nearly 500 million people will still be in extreme poverty. A good number will be living in hunger. Health will continue to be a crisis. CO2 emissions, while the intensity has fallen, the absolute numbers are still rising. And what I mean by intensity is that CO2 measured as a ratio of another unit, say revenue, CO2 emissions for a dollar that is spent or earned by a business. And deforestation is still going to be a challenge. And this calls for collective action by different stakeholders, government, civil society, companies alike. There is a place to contribute. I really like the principles that have been laid out by the UN Global Compact, which gives direction also to businesses as to which areas they need to make sustainable progress in. For example, the first two principles related to human rights require that businesses, corporations, and organizations should make strides towards providing dignified working conditions for their employees and not being complicit in human rights abuses. There is the requirement or principles that need to be upheld around non-discrimination, avoiding forced labor, or adopting principles that ensure that children's rights are protected even when they need to be engaged at the workplaces, for example, through internships and attachment. Businesses need to strive towards eliminating corruption in all its forms, including bribery and extortion. And on the environmental front, there is need to preserve the ecosystem from which businesses and organizations derive their value, which brings us to what I indicated to be the most holistic way to look at sustainability. When you have just economic progress and social progress, I look at that, and in alignment with the UN definitions as well, as having an equitable world. But you could be overusing your resources to the extent that the environment would not be able to support your subsistence in the future. If you just have environmental conservation and social progress, what you have is a world that's livable, but it's not truly sustainable because you don't have the resources that you might need to sustain development into the future. And the nexus between economic development and environmental conservation being a viable world that does not bring on board everyone and leads to some human rights abuses, for example, that we wouldn't want to see in the world today. That when you look at all these dimensions, to me, that's a sustainable world, and governance overarch all these elements as policy driver and an oversight function that is moving all these elements forward. As I mentioned, you can actually classify the different SDGs in between the pillars that we've talked about: economic, social, and environment, governance being outside of it to drive it all. Another reference that I want to make is to the UN Global Compact management model, which I believe is underlying all the initiatives around ESG and sustainability. At the very core of it, you need to commit to making progress, and that's driven by the governance function. You assess your risks and opportunities, and risks and opportunities need to be looked at with the double materiality eye, where you're both considering the impact that you're having in the ecosystem that you subsist, and also any risks that might arise from the environment that you subsist in and would impact your business as well at the end of the day. You define your goals, strategies, metrics, and targets. You move on to implementation. You measure your progress towards achievement of your goals and targets, and then you communicate consistently with the different stakeholders on what your progress is. And that's where the attention usually is on sustainability, impact, or ESG reporting. But that should just be a way to communicate on the achievements of the commitments which you have made. Let's make reference to one of the standards, which I believe is the most, or rather one of the most encompassing ones, covering multiple stakeholders and all the dimensions I spoke of as being crucial to a sustainable progress. Under economic dimension, you might be looking at revenue growth, which is important to some of the primary stakeholders, including investors and other shareholders within the business, how the business is growing within the market space, the indirect economic impacts that you're having. One of the organizations I know that reports really well on this is Safaricom within the Kenyan space, which has adopted true value assessment methodology to report on the indirect economic impact that they create within the ecosystem through employment of creating work for agents and reducing on costs generally of doing business. The procurement practices that a business adopts, the proportion of your procurement purchases that goes to local community or different groups that have been identified as being part of equality and equity discussions, be it gender or youth in relation to those who are older, anti-corruption practices. On the environmental dimension, you could consider your resource use so that you're not depleting resources that you will need in the future, how your water usage and how you optimize on it, how you treat wastes that are going into water bodies, the efforts that you're undertaking to reduce your greenhouse gas emissions, and how you handle the rest of waste such as paper, which you could have initiatives around recycling. And for plastics and glass, you could consider waste, the release of waste that does not degrade the environment further. On the social dimension, there are several conversations again and initiatives that one could consider. I would call generally responsible employment practices, which also considers health and safety within the workplace, the opportunities that you provide to employees for growth, the diversity and equal opportunity consideration within the workforce, but it also goes beyond just the employees to the society in which you subsist, the nature of products and services and safety considerations that are put into the solution, services, and products that you offer to your customers. And finally, on governance, I will classify them broadly into two categories: the responsibility of the board or the governing function to drive these other agenda, and two, the composition of the board itself, including such factors as equity within its composition. What is the percentage of local citizens who are part of the board? What is the gender distribution within the board? What opportunities are provided within the board to acquire knowledge that helps it to keep in step with societal changes and the business, micro and microeconomic context in which it operates? And so the world is responding. We are having mainstream conversation around ESG, sustainable finance, sustainable investing. And with that, there's also need for consistency in how these topics are addressed, and need also to be sure that when you're looking at a report and the monitoring mechanisms, the results or output of the monitoring mechanisms, they are giving you accurate information that you can rely on. There are different bodies that are driving this conversation. A lot of standards have been set, frameworks provided, some of them more prescriptive, some of them principle based. But let me specifically talk about an evolution that happened recently within the IFRS. integrated reporting, or rather the value reporting foundation, SASB, CDP, and TCFD rather, have come together under the ISSB to release IFRS sustainability standards. And GRI, which I mentioned as being a multi-stakeholder standard or framework, has also signed an MOU with IFRS so that some of the criteria or metrics, targets that they've already identified can be included when considering the sustainability standards that are going to be released. The ISSB already has issued the S1 and S2 standards. And these standards were released, I believe, back in 2023 with early adopters coming into play in the 2024-2025 financial reporting periods, but adoption, as I understand it, has been left to local jurisdictions as well. I understand Kenya would be adopting the standards formally in 2027. A little highlight or overview of these standards. S1 is a general standard that lays out the reporting framework and what needs to be considered when reporting on sustainability topics. S2 is what I would call a topic-specific standard, specifically relating to climate-related disclosures. It is an expectation that over time, we are going to see additional standards being released, S3, S4, which would be covering topics that cuts across the different dimensions that we talked about, including broader conversations on the environmental dimension, looking to address biodiversity laws and the broader environmental conservation efforts, other standards to address human capital and human rights concerns within organization. A little deep dive into the standards. The framework, given the merger or integration of TCFD within IFRS, the framework adopted for the standards is the same as what we'd seen earlier with TCFD, where you need to have a governing function or structure in place that accounts for the different procedures, controls, and processes to manage the sustainability related risks and opportunities. You need to identify the risks and opportunities that are sustainability related within your ecosystem, and then put in place strategies or management approach, that's the term used by GRI, to address these risks and opportunities, either to optimize on opportunities or mitigate against the negative risks that, or other risks that might result in negative impact to your business or organization. Core to measuring your progress is also setting targets. And to really report on your progress toward targets, you need to have metrics that you use to measure your progress across the different dimensions. This is also just highlighting within the governance body, you're talking about structure and the responsibility of management as well. You need to define your risk and opportunities. And when you are assessing materiality of the topics that you choose to report on, you need to assess the impacts of these risks and opportunities on your value chain, your strategy, and on financial and cash flows as well. Another thing that is important to have an indication of is the resilience of your strategy to these risks and opportunities within your ecosystem. I've hinted to metrics and targets already. I'm going to skip these, or rather, let me give an overview of these. In looking at governance, you need to define the governing body within your institution, report on whether they have appropriate competences to oversee the strategies that you have adopted to mitigate and manage the risks and opportunities, and their oversight over controls and procedures which are adopted within your context. Within the strategy, you need to look at your response to risks and opportunities, and the impacts in the context of the impacts that they would have within the short term, medium term, and long term, the current and anticipated risks and opportunities. Some risks might materialize in the future, and some of them you might experience them immediately. And I will provide an example of what that might look like, and the resilience of your strategy to risks that you have identified. Risk management, and this would be important to someone who's conducting an assurance and engagement. You need to be satisfied that the different processes adopted to identify, evaluate, and respond to the various risks is conclusive. The controls in place are effective and adequate, and the extent of materiality assessment is also holistic. In line with the in line with the risks and opportunities that you have identified, you also need to identify appropriate metrics and set targets in the context of the overall sustainable goals that we have. That's why I spent a lot of time to belabor the point on sustainable development, because at the end of the day, what we need to achieve is economic development or economic progress that is done in a socially responsible way, and in a way that also preserves the environment and the wider ecosystem for future generations. Just a little note, whenever we speak about emissions, it's a favorite topic around the climate change. Maybe in future we'll go in depth on climate change, and then we can talk about GHG emissions as well. But generally, Scope 1 relates to emissions resulting from direct business activities, to most of the time, primarily in the engagements I've had, Scope 2 has primarily been emissions resulting from electricity use. And 3 are indirect emissions, which, for example, can result from your use of vehicles that are managed by other institutions. Speak of Uber or public transportation services, or traveling through air transportation. What might the disclosures look like? There is general indication of how this can be approached. I know organizations that have already issued IFRS S1, S2 compliant standard or rather reports. And some of the approaches that we see in the market is one, including it as management commentary or other disclosures within the general purpose financial reports or financial statements, incorporating the various requirements of the standards within sustainability reports, impact reports, or integrated reports. But as I move on, let me also highlight that the key concern within the IFRS Sustainability 1 and 2 standards is the impact that the risks and opportunities have on finances and cash flows. These are some of the climate risk related, or rather climate related risks that, for example, you could see. Extreme weather events that impact the continuity of your operations or damages your property. I know last year there was a lot of flooding activities, and some of the experiences was that some businesses had to stop operation. And because I'm in insurance industry, you also see an increase in flood related claims. So and when you think about how that can impact your financials from an insurance perspective, you would be required to have IBNR provision set aside. And for businesses that stops, there is an impact on your revenues and expenses generally to restore operations. Let me speak about physical and transition risk. Physical risks are materializing from changes within the environment, put simply. Transition risks are those that result from moving, say, from one regulation to another regulation. You might, for example, find a legal framework or policy that looks to increase taxation of products that are deemed to have negative effect on the environment. And so you will have a transition risk that result from regulatory changes. Think about an instance where there is a proposed regulatory policy to ban fuel-powered trucks for an organization or business that is in logistics or transport industry. In such a case, you would identify that as a transition risk, which has the potential for you might need to dispose of your EV trucks and also, or rather petrol or diesel powered trucks, and acquire EV trucks or electric driven trucks. As a result, you'd need to make a provision for that anticipated expense, and also include a qualitative narrative of how that risk is impacting your financial statements generally. You would need, as we got on, there would be need to have more reliability or trust in the disclosures which are being made. Some of the challenges that we see in the market, there's the risk of greenwashing. The KPIs, the metrics and targets are either not exhaustive, or their definition is not very transparent. There is ambiguity in how organizations calculate and measure what they are reporting and presenting on. There is inadequate awareness, or rather awareness of the risks and opportunities and how they could impact the business needs to be improved. And generally, there is room for improvement even on the areas where we are already focusing on. It could be that you're undertaking certain action to conserve the environment, but you're not measuring or collecting the data in a transparent and accurate way. It could be that you're already undertaking a lot of initiatives or efforts around the social dimensions, but you're not capturing that as initiatives within the sustainability context. And then there is generally a need for more balanced view where you're both reporting on the positive progress you're making, the lapses that you're having, and the negative impact that you're having within your ecosystem as well. And that calls for an independent party to come in and assess the information that you're presenting and be sure, or rather give stakeholders confidence in what is reported. The different as elements or aspects that one could consider in providing assurance is one, concluding or offering a reasonable an opinion as to whether there's general compliance to the standards that an organization has adopted, the processes it has adopted to collect the data that it's reporting is adequate, efficient, effective, and provides you with accurate results. The extent of materiality assessment and the extent to which different stakeholder views are considered in setting boundaries and determining what's material for the organization. The assumptions, methodologies, protocols that you refer to when working out calculating different usages and emissions or diversity ratios within your organization, governance structure, the methodologies to identify and manage risks, the comprehensiveness of the targets that have been set and measures put in place to measure, to track the progress, the efficiency of the data collection practices, and the wider supply chain the involvement of the organization or company in the wider supply chain, including through conducting due diligence on the third parties or vendors and encouraging them to move together with you on the sustainability journey. But also the partnerships that you're forming to drive the conversation forward. Broadly speaking, whenever one is, this is specifically addressed to sustainability assurance service providers. Whenever you're providing assurance providers, or rather providing sustainability assurance services or undertaking assurance engagements, one of the reference standards is the International Standard on Assurance Engagement 3000, which is a general framework and would provide for independence of the party that's undertaking the assurance engagement, the level of documentation that you need to undertake, and the level of information that you need to assess to be able to provide either a limited assurance opinion or a reasonable assurance opinion. Limited is usually a negative opinion worded in the negative form. Nothing came to our disclosure to indicate that the information presented is inaccurate. That would be a loosely defined limited opinion, and reasonable assurance is what is common within the financial statements without limitations or disclaimers. Methodologies, you could conduct interviews, you could conduct sample testing, you can conduct observations, just the normal procedures typical of audit or assurance engagement. And with that, I really tried to move first so that we can have 10 or so minutes to receive comments and any questions that are coming up within the chat, or if someone wants to unmute and engage. That said, there is still opportunities for different assurance providers within the organizations or contexts that you are in to proactively move forward certain initiatives, evaluating the governance as part of your engagement and the readiness to adopt the different sustainability push or drive that is either now mandatory, or if one has been doing it voluntarily, the extent of the oversight that they've held over such topics, supporting the risk identification processes, evaluating the data accuracy and the measures in place to collect this data and enable its completeness, generally providing assurance over controls which relate to sustainability or ESG reporting, assessing readiness of the organization, and that is primarily important in this context where you would be required to adopt IFRS S1, S2 standards. Then you can support your organization as an assurance provider in assessing the readiness of the organization to report using these standards. Thank you. I'm going to pass the mic back to Michelle to guide us through the comments and Q&A.
Okay. Thank you, Becton, for that. You've really done a great job. We do have a question from Juliet. Juliet, we'd like to hear your voice, if that's okay with you.
Okay, thank you. Hi, everyone.
Hi.
Thank you so much for the presentation. I was just following up what you mentioned that Kenya will adopt the ESG standards by the year 2027. My question was, what standards are currently being implemented in the country? Also, coming from a public sector point of view.
Right.
Yeah, most organizations are trying and they keep on saying they'll implement ESG, but which is the guiding standard that we can use? Thank you.
That's a good question. Thank you for that. Now, before there was mandatory requirement on reporting, and this depends on different jurisdiction. Within the European Union, there was mandatory report disclosures in place through different standards and frameworks. Within our context in Kenya or in Africa generally, I am not sure there's been a universally adopted standard. However, different regulatory bodies have come up with different standards or reporting frameworks that they've tried to push to their members. I know CBK had some standards that it developed. NSC was pushing for the adoption of GRI-driven metrics within the market. But for the larger organizations have been doing reporting voluntarily, and they framework that I understand has been referenced widely within East Africa is the GRI. That said, the IFRS body, being an international body, now requires, as part of the financial statement disclosure process, you need to report on sustainability-related risk and opportunities and the impact they could have on your financial and cash flows, or generally the financial statements. This is what I'm referring to as now being a mandatory sustainability disclosure within our context. The ISSB left it to various jurisdictions to choose on when to adopt these standards, because different regions are prepared to different levels. Within the Kenyan market, ISPAC, together with other accounting practitioners, sat together and decided that mandatory adoption of the S1 and S2 standards will come in 2017. However, if you feel ready, you could as well start reporting this year early adoption. I know in Uganda, Tanzania, they will be adopting the reporting standards beginning this year. So they don't have the same latitude that we have in Kenya.
Okay, thank you.
Okay, I like how you've put it, Becton. I think in the not necessarily in the past, but we've seen a lot of engagement or involvement or use of actually GRI reporting, or the basis of GRI being used in reporting, things like identification of material topics. So that has been widely adopted, and I think IFRS S1 and S2 largely borrow from what GRI and the other standards have put in place. Yeah, but it continues. There's a lot of shift towards now IFRS S1 and S2, but they continue to be used concurrently, if not together. Okay. Any other question? Okay, so I had a bit of questions. From a board perspective, Becton, how would you say boards need to show up in this conversation? How can they, should I say, more upskill? How can they make themselves ready for this discussion, for this engagement? Should we have committees around sustainability and ESG? Should they sit in other committees? Where do you think the direction from a board perspective is going? Yeah.
That's an excellent suggestion, actually, to have a committee that specifically addresses sustainability concerns. The wider board as well need to be acclimatized to the topic, because when you have the policies, the initiatives being driven from the very top, then you are likely to have the support that you need. Now, boards usually need the support of the organization, executive management, and the different, what I'll pick an internal audit term here, lines of defenses in the traditional context to support them in driving different conversation. And so I would encourage also, if you're a member of an audit, risk, and compliance committee, through that board, make it known to the board that there are risks and opportunities around sustainability related concerns, and the importance of driving the conversation and supporting initiatives by executive management. Through the CEO, that communication need to be driven, and again through the various committees such as Audit and Risk Committee, they should organize for board awareness or sensitization sessions where these topics are discussed.
Okay, great. For me, I think that was the key question, because the other one I had was around there's so much data involved in this process, sustainability, ESG management. How do we ensure, or what would you advise someone who works in that space or collaborates or collates that data on how they can best manage that data so that they're avoiding the bit around what you mentioned around greenwashing, and in cases where maybe there's no assurance or there's limited assurance, they're giving data that's actually verifiable, complete, and adequate.
Right.
Sort of a parting shot, yeah.
That challenge has been coming up in the past. I believe, this is my opinion, mostly because the topics around ESG, sustainability have been looked at in isolation. When you have a more holistic view of it, end to end, and that's why I included the UNDP, the UN Global Compact model. When you commit, you assess, you set in place measures to collect data, and then you measure and communicate on your progress. What that would look like is that in identifying the risks and opportunities and defining initiatives or strategies to manage and mitigate them, you're clearly having specific initiatives or interventions that you've identified. When you set targets and in line with the metrics that you're using to measure, it becomes very clear what data you need to collect. And then you speak to the data team, if you have a data team, or IT, to support in developing processes and putting in place infrastructure to collect the data that you're going to need to make disclosures. And the assurance providers can chip in and provide assurance on the adequacy, effectiveness, efficiency of these processes and controls put in place to ascertain the accuracy and completeness of the data that's ultimately used for disclosure. So put in a summary way, identify the initiatives, the metrics that you can use to measure progress, the targets, and put in place infrastructure and processes to collect that data.
Okay, great. I think that's one of the things that I had noted down in terms of that methodology around committing, then assessing, defining, implementing, measuring, and communicating. I think the way you just put it in terms of, we focus a lot on the communicating bit. So we communicate a lot, and most probably even organizations focus on the positive impacts. They forget about what are some of the negative impacts our activities might be bringing on board. So it's good you've mentioned that. I think in future we could also talk about, in future sessions, we could dwell deeper on double materiality and scope 3. Yeah, I think I've seen a question from, okay, to Megan. She says, Megan, do you want to speak up? If you don't mind. Okay.
Right. I've seen the question on the chat. Do these standards relate to those using IFRS for SMEs? Yes. If you're using IFRS standards, or if IFRS standards has been adopted within your jurisdiction, then the expectation would be that you will adopt the S1 and S2 standards. However, there are certain reliefs which have been provided within the standards, so that, for example, within the first year of reporting, there is recognition. You might not have some data to enable you to report on some of the requirements. That's okay. There's a relief for that. And two, also for the a smaller organization, you will still have the leeway to explain either why a topic is not material in your context and you choose not to disclose on it. Generally speaking, depending on level of maturity and the size of the organization, you might have certain reliefs that would not make adopting the standards tedious for you.
Okay. I think that's the last one. We can call it a night or an evening. I think this was quite insightful, Becton, and thank you. I think we look forward to more sessions from yourself.
Hello.
Yes. Yes.
Excuse me.
Yes, Seraphine.
Yeah, I'm Seraphine. I just mine's not a question. I just wanted to say it was quite a good presentation there, and we'll be looking forward to another session. I don't know when. Did you say when we're having another session?
Probably Becton in 2 weeks.
That's going to be too soon for me. It's likely to be a very busy time. But what I can do is reach out and engage with you on when we can have the conversation again.
Oh, okay. Thank you. That was a good presentation. Thank you very much, and looking forward to more insightful session again.
Okay.
Thank you.
Maybe you could drop us your email. We could indicate when the next one is coming up. I know as at next week we'll be having a different session, specifically for the Kenyan market or Kenyan context around the Finance Bill 2025. But on sustainability, we'll get back to you when Becton is available.
Okay. Thank you.
Okay. Thank you. Okay. We can call it Becton?
Yes, thank you.
Okay. Please listen in on YouTube. Those who've not shared their emails. For those who've shared their emails, we'll share the video and the material. Thank you for your time and your attention. Lovely evening.